Does it make sense to save money in a whole life insurance policy? A lot of banks do it. A lot of corporations do it. A lot of wealthy families do it. But does it make sense for you? The answer could be yes, but it could also be a hard no possible way. Today, I'll go over when it can make sense and really what to know, what to look for when getting a whole life insurance policy so you can maximize the savings component, which is what is called the cash value of a whole life insurance policy. So I recently met with a couple. The husband is a retired engineer and the wife is a physician who currently earns a lot of income. Now, they're interested in a whole life insurance policy. I should say the wife is interested in a whole life insurance policy because her friend has a policy and recommended that she get one too. So she started to do some research, an introduction was made. We talked a little bit about a whole life insurance policy, but she said, my husband doesn't believe in life insurance. He doesn't like the idea of saving money in a whole life insurance policy. And the reason why is because he has owned whole life insurance in the past. Both him and his wife have, and they got a bad deal. That's why. So he thinks that life insurance is junk. And there is some truth to what he thinks because life insurance can be junk. In fact, I'll show you some junk in a little bit. But why he feels this way is because he's had a whole life insurance policy in the past and there is no cash value in the beginning. He paid a very high premium, had life insurance, no cash value to start. It took more than 10 years just to get his money back. He actually cashed the policies out before he even got his money back. So he felt like he took a loss because he did. And this is a big reason why he doesn't like life insurance. So this happens to a lot of people. And then what I'll often hear is life insurance should just be separate from savings. The two should not be mixed because it doesn't work. If you want to save money, save it in a different asset and then have insurance with a cheap term policy. You ever hear anything like that? That strategy can work, but whole life insurance can work too. There's a reason you'll see corporations and businesses and families put tons of money into the product for the cash value. The thing is, people are usually just sold a bad policy. And a bad policy, to be clear in this point, can be the same product, we pay the same amount of money every year with the exact same insurance company, and one option can look horrible and the other can look fantastic. It really has to do with who you're working with and how that agent sets your policy up. So awareness, one of my favorite words, is key here. It's important to be aware of how to set a policy up correctly. Another way to put it is, it's important to be aware of what not to do versus what to do. So here's exactly what we went through with this couple. So the wife is the one who is mainly interested in a policy. She is 54 years old. And what she's interested in is funding a policy with up to $50,000 per year. Notice my choice of words. Did I say funding with $50,000 per year? I said funding with up to $50,000 per year. And she wants to do this for about 10 years, right around the time that she'll retire. What's 50,000 times 10? $500,000 that she wants to put into a life insurance policy. Why? Why would she do that? Well, with a life insurance policy, when you look at the cash value, here's what everyone is interested in. Grows safely. It's liquid in the sense that I can access it anytime. If I follow IRS rules, it's tax-free. She earns a lot of money, therefore she's in a very high tax bracket. So the interest is there, and she wants to put a lot of money in too, $500,000. What should she not do? What she should not do is just get a life insurance policy where she pays $50,000 per year into the product. If you walk into an agency that sells life insurance and said, I want to put 50 grand per year into a life insurance policy, there is a very, very high probability that they are going to sell you a policy that I would probably say, here's a perfect example of exactly what you should not do, and it's exactly what the husband does not want. Let's take a look at this. So what you should not do is just buy a life insurance policy. Here you go. We're going to look at what is called a whole life 95 product. That's just the name of a life insurance product with Guardian in this case. But look at this section of the illustration. You're going to notice when we look at the next illustration, this stays exactly the same along with this info because it is the exact same product. First, what not to do. She pays $50,000 per year for a period of 10 years. We can scroll down, but after the 10th year, she pays nothing in. Here's what I want to hit on. Two things. First, year one, when I look at the cash value, $1,800. She paid $50,000. She has $1,800. If she cashes out, she will get $1,800. By the 10th year, she has paid in a total of $50,000 per year. She has $487,000. 10 years in, she still has less in cash value than what she has paid into the product. So she took a huge loss up front. She is still running a loss by the 10th year. And because it is set up with all premium, she gets a bill for this every year. She is required to pay this. So it is not a flexible policy by any means. With a life insurance policy, your money can go toward the premium or toward what is called the paid up additions or PUA rider. I like to call it a cash dumping. So have this in mind. Check this out. So what we'll look at next is the exact same product, but set up differently. The product's the same. You'll notice different riders here. So there are a lot of things we added to this policy, but for her, it's the same product with the same insurance company and the same out-of-pocket she pays in every year. Where you can see that is if we go down to the number section, here's her payment, $50K per year for 10 years. If we focus just on the first year, like we did in the last example, instead of $1,800, it is just about $44,000. Same exact product. If we look at the 10th year, she's paid in $500. She's got about $584. World of difference, isn't there? Yeah. Same product, same insurance company, same out of pocket to her. What's the difference? You may have taken note of all of this information up here. While she is paying the same $50,000, her premium is not $50,000. It's $4,500 and change. Her true minimum is the $4,500 plus that $724. What that is a term insurance rider we've attached to a life insurance policy. You can actually see a breakdown up here. Here's your whole life death benefit. Here's your term benefit. Purpose of adding term is it prevents what is called a modified endowment contract, or a MEC, which is a taxable event. It also allows us to plow money into our paid up additions rider down here. That term rider is necessary. Like, that's what keeps our costs low and maximizes the cash value of this product. So let's take a look at a side-by-side comparison here, shall we? So what we've got is our illustration of the junk version. She pays 50 grand per year for 10 years. By the 10th year, she's paid in 500. She has 487, pays nothing beginning the 11th year, and the cash value does grow, but man, not attractive at all, is it? Now, where's the money going? Base premium or PUA rider? All toward the base premium. That's the problem. Because it's all going toward premium, it's prioritizing life insurance first and cash value second. Versus this guy. Same out of pocket for her, $50K per year for 10 years. The difference, though, got about 10% here. The true base premium is actually a little bit less. I just rounded here to keep it simple. Then 90% here. We're stretching it as much as we can stretch it. Gives us a lot of cash value up front. The break-even point of year 4. And by the 10th year, you're at $583,000. Compared to the example on the left, you're at $487,000. Exact same company, exact same product, exact same out-of-pocket, just set up differently. And if you want to see how much more you have in cash value, short-term and long-term, there you go. Significant as time passes, and it only goes up just by setting up the policy correctly. This is what the husband did not know because he was never shown it. Why he was never shown it? There's two reasons, two possible reasons. One, a lot of agents don't know. The industry does not train on this. I say that from experience. Most agencies will just train on selling whole life insurance policies like what you see to the left, basic whole life insurance products. The main reason why is because they're the most profitable. It also takes a long time to learn the ins and outs, particularly around the long-term MEC laws, the PUA limits. There's more of a learning curve if you're going to set up a policy with a very low premium, which is set up for high cash value. So it takes more time to learn this, less money is paid, and agencies a lot of times don't train on it. Some do. There are some out there that do, but in my experience, many do not. I'm talking about agencies that a new individual might sign on as a career agent with a certain insurance company and say, I'm going to represent them and sell life insurance. That's what I mean when I say that. Now, the other reason why is because agents are often not willing to sell this either. So if I were to sell this product with Guardian and set it up these two different ways, with this option to the left with a $50,000 base premium, I would make $42,500 in the first year alone. There are renewal commissions. They're significantly less than the first year, but that's the first year. Whereas over here, combining the premium and the PUA, I would make $5,700 in the first year. That's the incentive. So the hard part for consumers, I'll start with that and then say the hard part for agents. The hard part for consumers, which would be you in this example, is that the industry literally incentivizes us to sell products that have higher premiums and have less cash value up front. Sometimes I'll see people try to play it in the middle where they'll put the premium at 25% or they'll put it at 30 or 40% of the total payment, put the rest into PUAs and say, this is going to give you more long-term. Yeah, that's junk. No, I think they're just trying to raise that to make a higher commission. Just what I think, could be wrong. But higher the premium results in less cash value, especially up front, no matter how you spin it. It also results in more compensation. So again, from the consumer's perspective, the industry is incentivized to sell the opposite. Incentivized, meaning they get paid more to sell you something that you probably don't want. Whereas the high cash value design, the agent will have a harder time selling this, especially in the beginning, because the profit margin is very, very slow. Unless it's just a single individual, guy or girl that's starting out brand new, has the knowledge to do this, and they can sell policies one at a time, and they don't have that much overhead. It can work that way because somebody puts in 50 grand and you make $5,700. That's not bad at all, in my opinion. I say that because that's exactly what I did. So just one sale at a time for a long time. It's how it grew over time. And then we still do a lot of volume and prioritize service. So we do have a lot of overhead, but it requires volume and other products and services that we offer in order to sustain that model. But it is harder as an agent to do it that way. And there's a lot more education that's required if you're working with someone who's an engineer, like in this particular case. But anyway, to wrap this up, what would I not do? I would not get a policy that is just life insurance first, and to be very specific, I would not get a policy that has a high base premium. Because if the base premium is high, that means I am prioritizing life insurance first and cash value second. Instead, I would get a policy with a low base premium. Let's do it this way. Don't you love technology? Remember the old school days with the classic whiteboard? You have to rewrite it or erase it. Then a PUA rider that is maximized. If I'm looking at some of the major mutual companies, a lot of times I can put 10 times the amount of whatever my base premium is into PUAs per year. Also, remember that item I mentioned earlier? She wanted to pay up to $50,000 per year. you've got it set up like the second example we saw with the 5K minimum, she can set it up where she's literally only billed for the 5K per year, and then PUAs can be added at her discretion. This way, it's very flexible, and she's not on the hook for a $50,000 bill every year. So if the policy is set up correctly, you have a lot less stress as well, in the sense of not having to be on the hook for this big bill every single year. Anyway, what I would do is get a policy with a low premium, high PUA rider. If you say, Steve, what does that mean? In the first year, here's an easy way to tell. Look for somewhere between 80 and 90% of whatever you pay in cash value, and look for a break-even point somewhere between 3 to 5 years. Notice the good example for her broke even right around year 4. That's what I would do. Let us know your thoughts on this video. If you have any questions, let us know in the comments below. And as always, I hope this helps.